It's interesting. I like I don't care about the market reaction. I like what I think that's really important about this is that I just can't believe we're not going to have an incredible amount of opportunity. Meaning that I think right now we're at a level where we're at a level of complacency which bodes well for the next 4 years with respect to what I think we're going to see, which is a normalization of higher levels of implied volatility. And so, let's see what happens. I think when you go into we're 8 years separated from the last administration change, and I think that that was the exact opposite. That was in the middle of this incredible market capitulation and meltdown in January of 2009, and now we're January 2017. Perfect 8-year cycle later, and we're at the exact opposite end of the spectrum, which is across the board complacency like we haven't seen, almost record lows in volatility. And I think it's interesting because the one thing that a lot of option traders point out is extremely high skew readings right now, which is a measure of 2, 3, and 4 standard deviation unmeasurable moves. And so I think that there's a lot of catastrophic insurance being bought, but a lot of near-term complacency, which makes for a very unique marketplace looking ahead, not looking ahead to the end of January or early February, but looking ahead to 2017. I think we're going to have an extremely volatile year and a good 4 years of trading.
It's funny you mention that, because when people say, "Oh, look at the volatility," there's no volatility in the market because they're looking at the VIX. But you and I know, you look at individual, and I think that's what you were referring to as a skew. I'm assuming you meant was individual stock movements, which are just incredible overnight moves on earnings or
no. Sorry, I should have been more clear. What I'm actually referring to is the way the pricing model is set up right now with respect to derivatives. No, the overnight moves in stocks have actually been understated dramatically. The last quarter, we've seen dramatic understatement of expected move. So that would be a little bit, I would say that's not the direction I wanted to take the conversation. What I was thinking, John, is that what the market's suggesting is that everything that is anticipated is actually inside of the expected move right now. But there's this 2, 3, 4, and 5 unmeasurable standard deviation type of risk out there that bid up extraordinarily high. So just imagine something like, you live on the coast, the weather is beautiful, but hurricane insurance is 5 times higher than it usually is. And that's kind of the marketplace we're in right now. People are not paying for normal market insurance. Like, people are not buying puts, people are not buying volatility, people are not buying protection, but what they are buying is catastrophic protection, out to moves that they can't even measure right now. So it's extremely interesting phenomenon. We haven't seen this in a long time. And for that reason, in addition to, we've just had, since 2013 to 2017 right now, we've had one of the lowest periods of historical, implied volatility. So we've essentially traded inside the expected move now for 4 years, which has been great for premium sellers, but it's not as interesting for market participants. And I think that that's all just, for me, and I am a premium seller, I think it's interesting in the sense that, you have to be very much awake right now. It's been a great trading period, and it's been good from an experimental side, but I think but I also think it raises a few red flags right now, and that's not a political statement or anything. It's just it's just a fact of 8 straight years of a bull market is a long time, as you know.
I can't disagree. As far as it's kind of interesting that what I've noticed with my own stuff. I went through, and I know we differ on how our means are different to our ends and on a lot of trades and analytics, but I've always been a proponent of studying, being from my early years studying with, the futures. Volume and open interest was a vital thing. And what we started off the conversation today with folks is, over the last 8-9 years, volume, in my opinion, observation has been masked by ETFs and option trades. So, the volume histogram that people had looked at has not been as effective. And what I see right now, which is really interesting about the skew that you talked about, is that volume right now and this rally, the rally that we have that's been underway, by all measurements, whether it's Joe Granville, which you and I have talked about, Joe Granville, on balance volume indicator he created. We talked about that on Tasty Trade years ago. For one of the very few times in a long time, is showing that the rally in the overall indices is on incredibly low volume. And it matches the histogram. And it is a concern for me that the market's rallying, and we're seeing this in IBM, and it's a phenomenon that I'm seeing in stocks, which is a different observation maybe, that we're getting a lot of stocks that are moving and a lot of sectors that are moving with no real volume behind it. And to me, I think that's, one goes with the other. So I don't know if there's a delayed reaction, if it's a sustainable rally up in here, but there is some, I think maybe that complacency of the market, or maybe the market's getting bid up and we're not seeing, the general small speculator just rush in and buy the high this time around. To me, that's a phenomenon that I can't put my finger on for the first time in a long time. I'm enjoying the ride a little bit, but like IBM's big push up here as it gets closing in at 176, 180 mark, hardly any volume associated with that compared to years past. So, Tom, that's kind of a concern, and I don't know if that's got a lot to do with the complacency issue you're talking about. You got any ideas on that?
Yeah, I think you hit the nail on the head when you first started when you first brought up the topic or the concept. This is a marketplace that's very different than markets that that we've traded in the past. And I say it a lot, in everyday discussions that I have on my show and when I'm doing live shows. And I talk a lot about how really good investors and really good traders today are very product indifferent. We are strategy indifferent and we are product indifferent. I think, you grew up and I grew up in a different era of floor traders when we pretty much, traded what we knew. And that's very different from, or traded one product that we were making markets in. That's very different from today's market maker, and that's very different from today's customer. As a customer today, just like you and just like everybody who's listening today, I'm an individual self-directed investor, and I am 100% product indifferent. I don't care if I'm trading the US dollar. I don't care if I'm trading the British pound. I don't care if I'm trading IBM, or I'm trading McDonald's, or I'm trading stock or options or futures, or I'm trading short vertical spreads or naked short calls in the bonds. To me, I am completely indifferent with respect to product and strategy, and it's just how we use our capital. So it does make sense to me that individual investors have gone away from looking at individual stocks unless there is, a specific implied volatility opportunity, meaning that fear is really high or really low, either side of the spectrum. And it does make sense to me that individuals are focused on liquidity. So when you're a liquidity freak, and John, I've become a liquidity product indifferent, but a liquidity freak, I am going to go where there's the tightest markets, because ultimately in the end, based on the number of times I want to do something, the tightest markets are going to provide me the greatest overall return. And it doesn't matter who has it doesn't matter, what that underlying product is. It just matters that I'm able to trade tight markets. So you're right. I am going to gravitate towards the top 50. There's 10 stocks that dominate. There's 10 underlyings that dominate. And beyond the 10, then there's the next list is about 40 deep. And then beyond that, there's probably 25 or 30 more. And you have about 75 to 80 underlyings out there that can support our definition of truly liquid global plays. Beyond that, it starts to get a little sketchy. So I completely understand, why you're seeing this kind of this volume divergence, and it makes sense to me as kind of the new age of investing and the new age of trading.
Tom, what you just said was huge. Liquidity. All right, so. I'm going to give you a trade that I did yesterday, right? And bullish the energy sector because seasonally, for me, it's my work. You know me.
Sure.
Commodity Traders Almanac, look for the energy sector.
Sure.
And I look for an edge. That's all I'm doing as a trade.
Okay.
And what I found, and again, what I look for is biggest bang for my buck, lower risk. I'm not into looking for home runs. I'm looking for, if I get a home run, that's fantastic, but I'm looking for lower risk, high probability trades.
Okay.
So I had a setup, a great one in Murphy Oil, stock symbol MUR. To me, it was a great little setup. It was lagging behind other energy stocks. Volume studies that I have looked fantastic on this thing. Bought the pullback, got filled at 31.42.
Okay.
Today, come in and I see this market running up and it's trading near 32. And I'm looking at, and I go, shoot, we got earnings tomorrow. And I start looking at the options, because this was a stock trade, not an option trade.
Okay.
I look at the options, and I'm like, well, first off, there's no weekly options. So that was my first problem. Second problem is the options were so thin, it was a little bit thin, being wider than, wide. I won't give an name. And so I would normally say, well, I like this stock so much, I am going to put on a collar. I'll sell it above the market call and use that to finance a put and ride it through earnings. So because they were pricing in a 10% move on this stock. Now it's a $31 stock, $32 today. A 10% move, to me, I'm like, man, I don't want to take a 10% risk. I got 2% profit in front of me, and there's no way to trade the option. So my druthers was, I just dumped the trade, took the 2%, the 8% move, and said sayonara. But I think your point about a list of high liquidity, I'm the kind of guy that I look for trade opportunity, and if a stock's a stock, I don't care if it's a butterfly wing, but I think the problem is that we're not seeing, as people get this impression that all stocks are great just because they have options, they're great. And they're not. And I think the expectation of earnings season, which is really cool, having of all people on right now during this time, Tom Sosnoff, is pretty cool in earnings season, because you talk some key words: standard deviation, it moves that are beyond what we would think, and how do people define risk, and do you take the money or do you put yourself in front of the trade train? So I guess I would ask you, what would you say to an individual investor when you're faced with those types of criteria?
I would say I'm very mechanical on this, John. I've changed a lot of the way I think, and I've become a much more active trader over the last couple of years than I even was, not on the floor, but since I've been a retail investor. So I would say you did absolutely the right thing. We actually won't trade an underlying that doesn't have where we can't trade the underlying options. Occasionally we'll trade a future where we don't trade the future options because there's no liquidity and we just want to make a small directional play. But when it comes to equities, you did the right thing. You put a trade on, it was a winning trade. You have no way to lower basis or enhance that trade. You take it off and you stick with the more liquid underlyings. You brought up you bring up a very interesting point that I think most individual investors miss, which is we've done a lot of research about trading, illiquid underlyings. That means underlyings that the stocks are usually liquid, but where they don't have liquid derivatives like liquid options or futures that don't have liquid, options or things like that. And it is extremely difficult over time to make money where there's no corresponding strategy or basis reduction opportunity. So for us, my focus is, again, getting back to pure liquidity. I can give you, my opinions on petroleum stocks and oil stocks and all that kind of stuff, but that's neither here nor there. I'm no more right or wrong than you or anybody else. Those are all just, those are just our own egos and our own opinions on the market. But when it comes to really making money, I believe the deciding factor is the liquidity, which basically means the choices you have around the strategies you can apply.
And I think that's important for, I guess it's 1 in the hand versus 2 in the bush. Take a profit when you get it. You don't want to do that. You want to let winners ride. But I think the thing is that, sometimes we get earnings surprises, and I always try to tell people, no matter how big you are, not percent. And people have to be able to make the determination. This is because the keyword of visceral. And it's everyone was like, if Trump wins, the world's coming to an end. It's a visceral kind of rather than an intellect market. Things should make sense and they kind of don't. And couple that with maybe computerized algorithmic trading, which is heightened to a an incredible level like I've never seen before. And I think that whatever it is, getting into consistency and not being a one-trick pony, I think, is the key. I mean, so whether it's doing an iron condor on a Netflix earnings and being wrong, saying it's going to stay under the implied move, but still making money by this. I mean, that's kind of thing. The key is to survive and in this environment until we start to see trends. And quite frankly, we don't have a big. I mean, the market overall is trending, but it's trending because we've got this incredible, I think, sector gyration, allocation that's on steroids. 1 week everyone's into utilities, the next is biotech, now it's technology. But anyway, I wanted you to come in because part of the theme was what's new, and the world has changed. Indicators, things have changed in the market, and there is a real big change in the brokerage end of the business. And I wonder if you know anything, what's changed in the brokerage end of the business?
Well, a couple of things, from thank you for setting me up, and I appreciate that. But you brought up a really interesting point there, which I just want to harp on for a second. I think, John, I just closed my application because when I put my application on, I lost your connection. I don't know if there's enough bandwidth or something. So I just closed down the new application because you couldn't, you came in a little fuzzy when I did that, so I didn't want to ruin what you're saying. But you talked about, we like to let our winners run. And one of the most interesting things that we've learned over, the last couple of years, we've basically built a think tank. And one of the things we've learned at this think tank is the appreciation for not letting winners run. There's actually no statistical evidence. There's a ton of validation about managing your winners just like you did. And there's no statistical evidence supporting letting your winners run. One of the biggest myths on Wall Street over the last, 5 or 6 decades has been the idea that you can manage your losers and let your winners run. And when it comes down to really researching it and validating it, there's almost no statistical proof, unless you're going to go to sleep for a few decades, of letting your winners run and being able to manage your losers. First of all, you can't manage your losers, and second of all, there's no advantage to letting your winners run. There's an optimal point of profit taking, which just means as soon as you have a certain level of profits that's sufficient to you take it. And then you can redeploy or do whatever else you want, or reduce basis, or improve your chance of success by using some, attaching some strategy to that. So I think you made a very valid point, with your first comment about taking your profits in Murphy Oil. With respect to the brokerage industry, and again, my goal here is, with the launch of Tastyworks and with what we're doing at Tasty Trade and Tastyworks, my goal is to change finance for individual investors. I'm going to blow up the myth that passive investing is actually healthy. I believe that passive investing is the single biggest destruction of wealth, because what it does is it takes people out of the business of being able to make decisions. So somebody like you that's made decisions in your trading career your entire adult life, it's second nature. But somebody that's listening to you for the first time, John, is sitting there going, wow, it's tough for me to make decisions about money. It's tough for me to decide when to take profits and when to take losses and what to do and how many times to do it. Once you've done that, a lot of times you have the ability to participate in the markets and take control over your own finances, your own wealth creation, and basically and your own strategy selection. And you don't pay all the fees. And so what we wanted to do was to create a brokerage firm that essentially catered to individuals that want to trade small, because I think one of the keys to managing risk is trading small in order entry, and then trade often, which means if you're up money, take your profit and move on to the next trade and redeploy. Because the more times that you do something, the better you will become at it. And again, there is absolutely zero statistical validation that riding positions into perpetuity or for however long is a successful strategy. There's a lot of proof that suggests that being able to manage your winners is something that you can't do anywhere else in an efficient marketplace except in the trading world. An example would be, let's say, you're a gambler. You and I have been to casinos together. We've been to boxing matches together over the years, and we've bet together. And one of the things that and I'm not throwing you under the bus here. It's, most traders have a little gambling bug in them. And one of the things that gamblers know is when you are up money, one of the things you can do is you can take it to the cage if you want to. It's very difficult, but you can. But one of the things you can't do when you're betting on something, especially like a football game or something like that, is if you're up in the first half, you can't take your profits at halftime and you have to let the game play out. And a lot of times, the game comes back and bites you in the butt. In the trading world, we want to make it second nature so that when you have a position that goes your way, what happens is if the statistical chance of success let's call it on a trade, John, like you bought this Murphy oil, the statistical chance of success on the Murphy oil trade, all things considered, is a slightly in your favor when you made the trade, just based on 53.47 being positive drift. But if that stock the first day goes up your way, the fact that you can take a profit on it is extremely advantageous over the long term to your expected return, because over time those returns that movement is supposed to normalize, and cyclicality will bring it up a little bit, down a little bit, up a little bit, down a little bit. And being able to time those winners versus those losers is extremely difficult. So being able to take profits when you're up money is extremely advantageous. Now, if you take it one step further and you use options or some kind of derivative associated with that, what happens then is if you buy the stock, for example, and then you sell the call against it, your statistical chance, like in Murphy oil, if there was an opportunity, would go from 53% in the stock all the way up to something in the neighborhood of 65 to 70% chance of success. That's just the covered call. If you then manage your winner early, your chance of success goes up into the 80s. That's an extreme difference for basically a coin toss up into the 80% chance of success if you can manage your winners. And that's pretty extraordinary.
So I think there's something that made a comment about trading. I took the liberty of switching over because I wanted people to see your Tastyworks website, Tom. I know that it may have gone down on your end, but I wanted to just bring.
No, I can see it now, but I didn't bring my software up because once I brought the software up, you got fuzzy, so I was trying to. That's all.
I understand. I appreciate that, but I do have your website up right now. I did it up on my end. I want to address someone's question, and I don't want to rub anyone the wrong way. Okay?
Sure.
So, Tom, let's be, trend trading. Buy and hold. I'm one that you let some winners ride, and I've scaled out of winners. I'm not one that ever seen anyone that pyramids, that adds and adds and adds, long-term successful. Now, maybe in a stock and holding a buy and hold, but you got, some guys that are like Valiant Pharmaceutical, that's an owie, that hurts. Amazon, Google, on the other hand, splits and things of that nature if you're running a fund. There was a comment that was made about other trend followers that have done great. One name that popped up, and I want to address this because I know the situation very, very well, and the guy's name was Richard Dennis, the turtle trader. And I want to address this because while he was a trend follower and a breakout trader, the turtle trader, Richard blew up 3 big funds and was actually kicked out of the commodity industry in 82, 84, and 87, I believe, were the funds that he blew up. So sometimes people, while someone has a reputation of being good, there are a lot of hedge fund managers that stick to winners and they don't know exit strategy. So I think that the key gift is sometimes one in the hand is worth 2 in the bush, and there is ways to do things. And I think what you bring to the table, Tom, of saying, hey, I'm not going to get into a trade. I can't. If I knew that Murphy oil, I'd like to trade solo, but if I knew I couldn't maybe ahead of time and I saw the earnings, I was not really afraid of the earnings, but when I saw the pricing in 10%, I went, oh my God, I'm not going to take a $3 hit if I'm wrong on this stock. I'll hedge by using an option. And I look at the options and there really is no options, right? So if I know that, I may have bypassed it and focused my attention elsewhere. So I think there's things that I want to address. Trading is about having the courage and the conviction to put the trade on and following a plan. And if your plan is to, based off indicators or based off a systematic program, it's just like, as you pointed out, gambling. You've made money, can't walk away off the table and leave Vegas with money. And that's the key to this business. It's not about who's right, who's wrong. It's about making money. And that's one of the things that trend followers, unless it's other people's money and you've got a 30-year plan, that's a different. But destructive innovation, by the way, Apple did wonders for Circuit City, right? I mean, as soon as the iPod came out, Circuit City built their store on CDs, and in like less than 6 months, no one was buying CDs. Everything was iTunes. So destructive innovation, things change, industry change, presidents change, directives change, and we need to be aware of that.
Yeah.
And what's really neat, speaking of the topic of change, is brokerage firms change. And now that we see Tasty Trade, what's it about?
It's a great quick question, because one of my favorite topics to debate is the concept of trends and outliers. And forget about Richard Dennis. I'm not even sure if I think he left the business broke, but there are an incredible number of investors. We're talking of hundreds of thousands, if not millions. And out of that group, there are definitely a certain number of what I would call outliers, the top 1, 2, or 3%. But I believe, unlike most other people, I believe the top 1, 2, and 3% are much closer to one-hit wonders than they are to true outliers. Which means, of course, you are going to have your outliers, and they are going to be successful based on time, i.e. the George Soroses and the Warren Buffetts and everybody else in that category. But there are also plenty of one-hit wonders, as you can see from, super rich hedge fund managers and super rich, portfolio managers that were just in the right place at the right time. There's nothing wrong with that. But that to me is not a skill. To me, the skill in this industry is an individual investor that can learn how to make money every year on their portfolio, taking advantage of a level playing field. To me, there is a skill being developed now on a daily basis, and it has nothing to do with trading trends. It has nothing to do, with being able to, to looking back at some of the so-called industry superstars. And I'm not really dissing anybody, and I'm not some egotistical nutcase, but I don't believe that there was much to it. And I believe that true trading strategies, which are now being proven, and you can go back and you can look at all the math models, and it's virtually impossible to discuss trends. Of course, there's people that bought Apple I bought Netflix at $9. I bought Amazon I sold the 7.5 puts in Amazon. I mean, we all saw the same movie. We all did the same stuff. I mean, some of these stocks, I bought Apple at $12, and it was in the 2000s. So, I mean, a lot of us, that does not make you into a great trader. That doesn't make you into a lucky trader. It doesn't make you into a great trader. That's not what trading is all about. The reason that we're here on a Tuesday afternoon, or the reason that we're here on a Friday night, or the reason that we look at our stuff and we study this stuff and we spend so much time and we're so passionate about this, is because I believe there are ways to take advantage of the business where you can create predictable outcomes. And that's something that the Richard Dennises of the world could not do. And that's something I believe that individual investors can do today, given the right fee structure, given the right technology, which we try to build, and I think we've done in the past and we're doing it again now, the right fee structure, which we've done for the first time, and the right content, which is people like you, people like me, and people that are really committed to delivering content that changes the way people's perception. Let's not try to go out and tell people that they can risk $1 to make $10. Let's explain to people that what you want to do is risk $7 to make $3, but have a very high chance of that working, and be able to manage that a lot earlier. And that's my philosophy on investing and trading, and that's my philosophy on building wealth.
We've got a couple great questions here, but on the purpose of buying and holding, I just wanted to remind you, I had to take a flight, and I was a Delta and an American airline guy, right? So with the Sky Miles and all that. and I had to go someplace, I don't remember where it was, I was forced to take Southwest Airlines, stock symbol LUV, L-U-V. And I think it was a time when I was on Tasty Trade, this would have been 2012 or 13, and you were like all about it, because I think you flew Southwest every chance you can, and I didn't get it until the plane landed. I'm like, well, they have internet. No wonder he loves this thing. So I want you to know, you kind of turned me on to that stock, and you didn't even realize it. But I think I shot you an email going, what the hell's with this company? You're like, oh yeah, I'm in it. I don't know. That was 4 or 5 years ago. I can't remember. I took my biggest position in an airline stock ever the day we reopened after 9/11, and so I don't remember the specific date. I was at the 15th or something when the market reopened, and Southwest opened at, I want to say it opened at 6 1/4. It may have traded down into the 5 handle. And I loved Southwest before that. I had been long at about, like around $9, and I was choking on some stock, and I bought a bunch of stock, and I couldn't hold it much past. I held it for a couple of years and couldn't make much more than, I want to say, $1 or $2 on it. Maybe I sold it out at 7.5 or 8. And I really held that stock for 2 years. So what you're telling is a very true story, because I was a Southwest freak. All I wanted to do was own a piece of that company. It was like always one of my dreams. I'm gonna load up as much Southwest Airlines as I can. I held it for a couple of years. It was one of my longest plays, and it never went anywhere. And then I think I scaled out maybe all the way up to, like, I don't know, 7, 8, 9, 10. And then what is it today? 4. I don't look at it anymore because it just makes me mad. But I think it's probably 42 or something. I don't really know. 49, but I'm not counting.
49. I think my last sale, the highest I ever traded the stock was probably $11. But that was my contrarian play for the day after 9/11, was to basically just load the boat in Southwest Airlines. I never would have done that today, because I trade completely different. I've been trading for 35 years, and almost as long as you. Been trading for 35 years, but I trade differently today. And in 2001, it was about, how much can I buy? And in 2017, it's just like, okay, this is an interesting contrarian play, but I'll do it small. I trade completely different today.
It's funny to go down memory lane with you. There's a bunch of others, but for practical purposes, for our audience, you're just an amazing human being, and you've been important in my life, so you know that. And that's why I'm thrilled that you're here today, because I know your schedule's like crazy. But we have some pretty decent questions, and I want to give you the chance.
Fire away. Fire away.
On Tastyworks.
Yeah.
Right? So, fee structure.
Sure.
It's a really good question. Someone says, please discuss fee structure and why you selected it.
So I wanted to do something that had never been done before. First of all, the idea of free trading is impossible, because if you're going to build good technology, you have to spend a ridiculous amount of money on technology, infrastructure, and everything else. But I wanted to do the next best thing. I decided that it's ridiculous for financial service companies to be 5 or 6% of the GDP, and this industry has been good to me. So I wanted to give something back. So I said, we're going to build a business that has a much lower profit structure. I'm not going to go for 50%. If we can survive on 10, 12, 13% profits, we'll be successful if we can get enough customers. So what I said was, figured out what's the lowest we can go to, and just have one fee structure. No negotiation. Nobody can have a different rate, whether you work for us, no matter who you are, if you're the biggest trader in this world, the smallest trader, if you have $2 million or $2,000, if you have $20 million or $20,000, doesn't make any difference. Our rates are, you only pay one way. So for example, if you want to buy or sell stock, no matter how much you want to buy or sell, it's $5 to buy and it's $0 to sell. If you want to trade a future, it's $2.50 to buy it, it's $0 to sell it. If you want to trade an option, it's $1 to buy and it's $0 to sell it. And then what we do is if there's exchange fees or clearing costs, we just pass those through to the customers. And so all we make is that fee that all that we make is the fee that we charge. And then if we get any payment for order flow, we get that, of course, as well. But that's it. And it's about as low as we can go. It's probably somewhere for most brokerage customers between 40 and 70% lower than the rest of the street. And when you trade a lot, like I trade 9,000, the last 2 years I've traded about 9,000 trades a year. And for me, you know, of course that's a lot of trading, but it's a significant dollar amount. And I think for everybody, even if you pay $1,000 a year in commissions, you know, it's a huge number. My goal was to get the average trader, John, from down to somewhere between 6 and 10% of their activity in transaction fees. And I think if that's the case, you can be very successful. The problem is for most active traders, they were up somewhere between 12 and 25%, and that's really hard to be successful. So our goal was to cut that in half or by 2/3. And I think we built a commission schedule that allows people to do it. I mean, you know, you pay $1 to buy or sell an option, you pay nothing to get out of it. There's no reason not to manage your winners.
So I have projected on the screen here, it says right here on Tastyworks platform, it says 0 commission to close.
Yeah.
Options opening trade, $1 per contract.
Yeah.
So if I did, let's say I did a 40 lot IC, an iron condor, 40 size iron conduit.
You mean
right?
you mean 10 contracts or 40 contracts?
No, 40.
Okay.
40 contracts, so that would be 100, you know,
160 bucks.
460 contracts. So is it the iron condor, which is a 4-way strategy?
Yeah.
Is that one trade, or is that 4 contracts?
No, it's per contract. If you did 40 iron condors,
that trade is going to cost me only going to cost me 160 on that.
$160, and then it costs you nothing to get out of it.
So that's the math that I was thinking you were saying. I just wanted to be clear. If I heard it, I wanted the audience and clients to hear it as well.
But I want.
That's what I was going with that. That's all.
And that's correct. And I want people to trade small though. The average size trade, let's say it's more like 5 contracts or 3 contracts. You know, because that's what I want people to be able to. People don't need to do 40 lots of iron condors. Most people should be trading 3s, 5s, 7s, 10s, whatever it is. But if you trade 5 iron condors, that costs you $20 with us. With most other firms, with most.
So Tom, that's a good point. Let's stop there. On what size account? Because that's position size management. On what size account would you say on an iron condor that maybe you collect 2 and your risk is $3, right?
Yeah.
I collect 2, I'm risking 3. What size account should a guy only be doing 3 to 5 iron condors?
So if you're risking an iron condor, let's just say it's $5 wide, the strikes, right? And so you're collecting $2 and you're risking $3. That means your statistical chance of success is approximately 60%. It's a 60-40 split your way. You're collecting 40% of the width of the strikes. That means you have a 60% probability of success. That means if you were wrong, your max loss is $300 per contract, right? For an average size account, now, and I'll explain what average is, but for an average size account, you probably want to risk no more on a defined risk trade than 1 to 2% of your capital, max. If it's a large account, you want it between 0.3 and 0.7 of 1%. So if you're talking about a $100,000 account, a 5 lot is plenty. Probably you should be closer to 3 contracts to 5 contracts. If you're talking about a $20,000 account, it's probably going to be max 2, maybe 1. But the problem in this industry, and this is the reason that most people are not successful, is that we have to trade too big to overcome the fee structure, which is like some ridiculous ticket charge of like, you know, $9.95 plus then 75 cents a contract, or it's some number, whatever it is, doesn't matter what it is. And what I wanted to do was that makes it cost prohibitive, so people trade too big, and when you trade too big, genius fails. So what I want to happen is to create a brokerage firm and to create a way for small investors, individual investors, to be able to trade size appropriate. So if you have a $25,000 account, a $50,000 account, or a $100,000 account, and you want to trade a 2 lot, a 3 lot, a 5 lot, or an 8 lot, whatever it is, the transaction costs have 0 effect, negative impact. And you're able to trade any size that you want, and you can actually trade size appropriate, which allows you to create more occurrences, which allows you to be statistically far more successful. The individual investor that cannot create enough occurrences because of a lack of capital cannot be successful over time, hence the reason for the high failure rate. If all we do is change the position size and make it smaller so people can trade small and trade often, we'll have more liquid markets and we'll double the percentage of successful traders.
Excuse me for taking the liberty to write on the screen, but we had a question, and before we move,
Sure.
I assume these are your peeps and my peeps as well.
Fire away.
Friends and clients. I assumed, so I made the old odd couple with Felix doing the court thing. I assumed making that people knew what an iron condor was. Someone said, "What is an iron condor?" And I'm just putting it up. It's a credit call spread with a credit put spread behind it, and you're looking for the market to maybe move between the two levels. Sometimes those are great strategies when the implied volatility is extremely high and you can sell premium both sides. Like if you're expecting on an earnings play, sometimes an iron condor might be a decent strategy. So that's what we were talking about as an iron condor. So I just wanted to ask that, to answer that gentleman's question, number one, and I'm sorry, Tom, you might have a different opinion on the time and around when you would do an iron condor as well, but it's a strategy, pretty much it's a credit call spread and a credit put spread put on simultaneously.
And you're exactly right. Put on simultaneously, and the ideal situation for the ideal time for that is in periods of extreme high volatility, and the ideal days to expiration you'd like to have is around 45 days. So you were exactly right. You were spot on.
Well, thank you, because there's nothing worse than trading options for 35 years and not knowing what you're doing. So thank you. Now, we have some questions. Besides that one, that was a good one.
Fire away.
What are your contract requirements and margin on ES? So that's one.
We're launching futures on March 1st, and there's is the question, we're using span margining, so it's whatever span margining is. Are you asking intraday requirements or overnight?
I don't know. It doesn't ask.
Okay.
Your overnight margin is what the exchange sets. Tom's can't come up with less. He can increase it, but he's probably just doing what the exchange passes on.
Are you going
to offer intraday reduced margin day for day traders?
Yes. Overnight, John, you're exactly right. It's the minimum that the exchange requires, which is the same for every brokerage firm. Intraday, we're doing 25% of overnight.
All right. I know there's an echo, is because I've got my mic on so people can hear me, and I don't mean to talk over Tom, but I'm the guy that's getting the question. So, Tom, I'm going to answer this question for you. Can a Canadian open an account? And I think the answer is no. Your answer is?
The answer is no.
All right, so hopefully we will resolve the bad echo doing it one question at a time. Next, so the futures aren't until March, folks. Canadians can't open an account yet.
Yes.
All right. Do you have demo accounts?
We do not have paper trading, if that's the question. Once you receive an invitation to open an account, you can download the platform and you can play with it, but we don't have paper trading or virtual trading yet. We will offer that in June.
All right, so this is the purpose of coming in on 2017, and let's all agree, exciting times. I mean, there were executive orders flying, there's people marching around the country, there's new things, there's products, there's ways to trade, exciting education, and now a brokerage firm that's giving active traders a reduced fee, something that was very unusual last year that the exchange, and I'm speaking the Chicago Mercantile Exchange, did, which was kind of like charge you to walk into the casino. They charge for quotes. And it's refreshing that everything's electronic. We put on our own risk. Execution's always a problem. Execution risk, my favorite phrase, or one of my top phrases, is the market will always let you in every single loser. Sometimes it doesn't let you in on the winners. You missed it by a tick, whatever. But at least we have, a basis of looking at a new, by an established individual who's been there, created quality products, launching a new brokerage firm in 2017. So that's
Sure.
really, really exciting, Tom. And I thank you so much for coming back. And last week, I know technology gremlins took over. It happens. And a lot of our folks were very grateful that you made your time to come and talk with us. I love the skew comments. I really like the standard deviation talk. This light volume rally concept, the cost of taking higher protection in the market. It's kind of a weird environment, and we're going to have some exciting trades. So we're going to want to have stability, good product, place those trades, and I think that it's just a bright 2017, and I don't know where you're at, but I think you're going to say the same.
John, I thank you for having me. I know we had technical issues last time with the audio, and so I felt it was really important to come back on and give everybody a chance to hear what we had to say. I love speaking with you. I love doing live shows with you. I've always loved, you and I are two peas in a pod, and not politically, but we're two peas in a pod that can sit around and talk about trading, probably until 6 o'clock in the morning. So,
all right. So one last quick funny story. So the original Tasty Trade office in the Brownstone building, and I can't remember off Dearborn, right?
Yeah, it was on Huron, right?
Side street.
Yeah, Huron.
Okay. So you invite me in, and I don't remember. I think it was October. It was sort of sunny in Chicago. I can't remember. It was the first year you launched Tasty Trade. I come down, and I think it was the election, and no, it was 2000. I think it was 12, and there was a hairstylist, and there's a modeling agency. I can't remember which one, and so. I mean, I know Bat, the reason he loved working with you is because of the modeling agency. I don't know if he's gotten over that.
He has not.
You guys moved.
He has not.
He's not gotten over that. All right, so all these models would come and go, but there was this hairdressing salon with this big sign of Obama, President Obama at the time, and his re-election. It says, "We've got your back" sign. And I come up into your office, and I'm like, how come no one's taking that sign down? And you went, you like gave me like the 50 degrees of shades of darkness of why I should be a Democrat, and it was kind of funny. But I went, I'm open mouth, insert foot. So, again, we do agree on a lot of different things, and we'll leave it at that. So, hey,
John, we are passionate free market capitalists. That's all that matters.
At the end of the day, that's it. So, listen, Tom, we love you. Thank you so much. Congratulations. And, in March or maybe earlier, if you got the time and things as it's progressing, we'd love to have you come back on if you got time, chat more about markets. I'll see you. I'm not doing any trade shows for a while, I think in May, so I'm taking a reprieve from those. And I'll see you on the road another time. And when our paths cross, I wish you coming back. You mentioned March. Maybe we do a redo in March and see how things are going, and or sooner. Keep in touch. I will as well. Love you, brother. Thank you so much, man.
Thanks, John. You're a good man. Thanks.